Welcome to the Deep Dive. We're here to cut through the corporate jargon and really get to the core insights you need. Today, we're taking a close look, a real magnifying glass approach, to the Q3 2025 earnings call and presentation from a major financial platform. This is a company that's, well, it's managing incredible traditional financial success while also making some pretty big volatile bets on the future of finance.
Yeah, absolutely. This report came out November 5th, 2025, and honestly, it feels less like a standard earnings report and more like maybe a declaration of intent against the old financial system.
A declaration.
Definitely. If you had to boil it down to one core theme from them, it's this phrase they kept using: relentless product velocity.
Relentless product velocity.
And the headline number, it's frankly staggering. Total net revenues doubled year over year, came in just under $1.3 billion.
Doubled. Wow.
Yeah, this isn't just, steady growth. This looks like a company really flooring the accelerator across the board.
Doubling revenue at that scale.
Yeah.
It's just phenomenal. So our mission for you today is really to unpack that performance. We need to look at the two sort of distinct engines driving it because, like you said, it's this surprising mix of volatile new stuff and very old school banking.
Right.
And then we absolutely have to analyze this incredibly ambitious, maybe even high-risk roadmap they've laid out. They're aiming to become what they call the global financial ecosystem.
It's definitely ambitious. It's a roadmap that has huge potential upside for sure, but the regulatory shadow hanging over it is just as massive.
How so?
Well, they're aggressively pushing the boundaries, stretching what might be legally possible for retail investors in several areas. We'll get into that.
Okay, yeah, let's pin that. But first, the numbers, because you can't argue with them. They are glowing. Total net revenue is $1.27 billion.
Yep.
And beyond that top line.
Net income shot up 271% year over year. That's $556 million. And diluted EPS up 259% to $0.61 per share.
Just incredible growth. So when we talk about the drivers, you mentioned this dual engine idea. Which one was really providing the most horsepower this quarter?
Well, surprisingly, both were running pretty much flat out. The new engine, let's call it transaction-based revenue, that soared 129% year over year to $730 million.
There's $130 million from transactions.
Right. And crypto was the real rocket fuel in there. Crypto revenue specifically was up over 300%.
300%.
Yeah, to $268 million. And that's backed by some serious volume, $80 billion in crypto notional trading volumes. That kind of growth, it reflects real interest, sure, but also serious trading activity in digital assets during Q3.
Okay, it's easy to look at that 300% jump in crypto and just say, okay, crypto drove everything. But how much of that transaction growth realistically was maybe just riding the wave of broader market momentum in 2025 versus their specific strategy?
That's a fair question. But I think if it were just market momentum, you probably wouldn't see their traditional asset trading volumes also hitting records. Equities notional trading volumes, for example, hit a record $647 billion. That's up 126% year over year.
$647 billion in equities.
Yeah. And maybe even more telling for their strategy, options contracts traded increased 38% year over year to another record 610 million contracts.
So options are booming too.
Right. And that suggests the platform is becoming stickier for more sophisticated traders, people who trade derivatives, not just beginners buying a fraction of a stock,
Right. That makes sense. Okay, so that's the new engine firing. But the old school engine, the net interest revenue, that's kind of the ballast here, isn't it? It increased 66% year over year to $456 million.
Yeah, almost $500 million just from interest. It's huge.
So what's driving that? What balance sheet metrics tell us how they pulled off that massive increase?
This is where you really see their success in attracting, well, serious money. Net interest revenue, it's driven by holding interest-earning assets, right?
Right.
And those assets grew 55% year over year to a pretty whopping $64 billion.
$64 billion.
Yep. And if you break that down, there are two key levers really working well for them here. First, customer money that isn't being actively traded. They call it cash sweep balances that hit a record at $35.4 billion.
Okay, just to clarify, the cash sweep growth, that's basically money customers are trusting them to hold, even if it's not being used for trading day to day. That seems like a big vote of confidence.
Exactly. It really shows they're succeeding in becoming more of a primary financial relationship for people, not just, a side app for trading stocks.
Okay. And the second lever.
The second one is their margin book. That's the amount customers borrow against their securities. It grew an absolutely astonishing 153% year over year.
153%.
Yeah, up to $13.9 billion. Now, the margin book is critical because it generates really high margin interest income for them, and its size signals they're successfully attracting bigger, more sophisticated customers. The kind who use leverage, a service you normally associate with the old-school legacy brokerage houses.
Right. The fact that they're pulling in these sophisticated users, people who borrow significant amounts and hold substantial cash balances, that really does change the narrative around the platform, doesn't it?
It absolutely does.
And this pivot, I think, is quantified perfectly when you look at the customer engagement metrics.
It really is. Total platform assets were up 119% year over year. They're now holding $333 billion.
$333 billion.
Yeah. When you think about that scale and moving from just attracting brand new investors to holding that much money, it reflects a genuine shift, a sea change in how they're perceived in the market.
And maybe the most important metric for future stickiness, at least in my view, is how they're doing with their premium service adoption.
Oh, absolutely crucial. Robinhood Gold subscribers reached 3.9 million. That's a 77% increase year over year.
Almost 4 million gold subscribers.
Right. And these customers are typically highly engaged, very valuable. They were a big driver behind the net deposits, which totaled $20.4 billion just in Q3.
$20 billion in net deposits in one quarter.
Yeah. It represents a 29% annualized growth rate compared to the assets they held at the end of Q2. So the platform is clearly moving beyond being just a transactional tool. It's becoming a sticky, more comprehensive financial platform.
In this transition, it leads us right into the CEO's stated mission, doesn't it? He laid out these 3 strategic pillars that really define their ambition going forward. What exactly are they trying to become?
They're trying to dominate essentially 3 big spaces all at once. Pillar 1, be number 1 for active traders.
Okay.
And they were explicit about this. They said they want active traders to feel like they're at a disadvantage if they trade anywhere else.
Strong words. Pillar 2.
Be number 1 in wallet share for the next generation. Capture the younger demographic's primary financial relationship.
Makes sense. And pillar 3.
This is the big one. Be the number 1 global financial ecosystem.
That's certainly audacious. But, haven't we heard these global ecosystem claims from pretty much every fintech company for the last decade? What makes their current execution feel different or, frankly, more believable this time?
I think the difference is the sheer speed of their feature deployment. It brings us back to that phrase, relentless product velocity.
Okay.
They're not just talking. They're building highly specialized tools aimed squarely at that active trader community, a group that's traditionally been very loyal to competitor platforms like Interactive Brokers or Schwab's Thinkorswim.
All right, let's dig into those specific active trader tools they mentioned rolling out.
Sure. The roadmap for active traders, it's clearly designed to pull veteran users over. So in the coming months, they're rolling out the ability for short selling.
Finally adding shorting. That's a pretty fundamental tool for serious trading that's been missing, right?
Exactly. It's table stakes for attracting pros. Then, early in 2026, they plan to launch Robinhood Cortex indicators and scanners. These will be part of their premium tier, which they're calling Robinhood Legend, available to Gold subscribers.
Okay, for the listener who maybe doesn't live inside trading forums all day, what exactly are Cortex indicators and scanners? And why would an active trader actually switch platforms just for that?
Good question. Think of them as advanced automated analysis tools. Scanners help traders rapidly filter through thousands of stocks based on technical signals, like identifying stocks showing unusual volume or hitting certain price patterns, things like that.
Okay, finding opportunities quickly.
Right. And Cortex refers to their own in-house suite of indicators. These supposedly analyze things like market depth and order flow data. Basically, they're providing the kind of high-speed data analysis tools that serious day traders, often those using algorithms, really need to execute their strategies effectively.
So they're essentially trying to equip their retail users with tools that were previously more in the institutional domain.
That's exactly the play. They're also introducing overnight index options early next year, which again cements their focus on the high-volume derivatives trader.
Okay, so they're building the tool set for serious traders. Are they also trying to build the community around it? Where does this Robinhood Social thing fit in?
Robinhood Social, yeah, that's also slated for early 2026. The idea seems to be merging social media engagement with hopefully more credible finance discussion.
How credible, though? Finance Twitter isn't always the most reliable source.
Well, their angle is leveraging verification of traders. So presumably, you can see if the person posting actually holds or trades what they're talking about. They hope this distinguishes higher quality analysis from just, random noise or pumping.
Interesting.
The goal seems pretty simple. If you're trading options on their platform, they want you talking about options on their platform. Create a sticky, self-reinforcing loop.
Right, keep everything in-house. Okay, now let's get to the really high-risk, high-reward future bets, the ones that define that global ecosystem pillar. Let's start with Robinhood Ventures. This is the plan to give non-accredited retail investors access to private companies, right? How are they trying to craft that nut?
Yeah, this is a big one. The core idea, the thesis, is really about democratizing access. Management keeps pointing out that 85% of Americans are non-accredited today.
85%.
Right. And that means they're basically shut out from investing in companies before they go public, where a lot of value creation happens these days, especially with companies staying private longer.
And customers actually want this.
Apparently, it's one of the top requests they get. Customers want access to potentially higher growth private companies, maybe with the hope of daily liquidity somehow, and the ability to have more concentrated bets than a typical mutual fund allows.
Okay, so what's the actual product or mechanism?
They're working on offering access through a managed fund called Robinhood Ventures 1. This fund would hold, presumably, concentrated positions in various private company stakes.
And how far along are they legally with this? Because cracking open the private markets for the average Joe, that sounds like a huge regulatory lift.
It is enormous. Robinhood Ventures 1 is currently on file with the SEC. They mentioned they're in the quiet period right now.
What does the quiet period signify, practically?
It means the application is under intense review by the regulators at the SEC. They can't publicly promote the fund or solicit investment yet. But the clock is ticking, and the SEC has to determine if the structure actually meets all the stringent requirements needed to protect retail investors getting into this new, complex, and often illiquid asset class.
So success here isn't guaranteed at all.
Not at all. But if they do get it approved, it could fundamentally alter how wealth creation happens, or at least who gets access to it in the U.S.
Okay, that's a massive bet.
Yeah.
Equally ambitious, maybe even more radical globally, is their crypto and tokenization strategy. The CEO had a very specific, very aggressive quote on this.
He did. He flat out stated that tokenization will eat the broader financial system.
Wow. That's a maximalist view, to say the least.
It really is. And they're moving fast on it, especially globally. Phase 1 is already happening in the EU. They now offer over 400 stock tokens.
SEPA token, so digital representations of shares?
Essentially, yeah, digital tokens representing ownership in publicly traded companies. And they're aiming to have the largest selection available anywhere.
Okay. So what does that mean for their recent, pretty crucial acquisition of Bitstamp? Where do the next phases of this tokenization plan lead?
Bitstamp, which they bought back in Q2 2025, is cited as absolutely crucial here. Phase 2, they said, will involve making these stock tokens available for secondary trading on Bitstamp. That provides the liquidity piece.
Okay, so Bitstamp becomes the exchange for these tokens.
Right. And Bitstamp is also key because it gives them their first real scaled institutional business, which they need for global reach and credibility. Phase 3 is where, in the CEO's words, the possibilities start to multiply. Meaning expanding deeper into DeFi, decentralized finance, moving beyond just tokenizing traditional assets like stocks into potentially entirely new financial products and primitives built on blockchain rails.
Okay, so this is lightning fast rollout, global expansion.
Yeah.
That always comes with costs, right?
Yeah.
We saw the expense outlook for 2025 got adjusted upward. What drove that jump to about $2.28 billion?
Yeah, the reasons were basically twofold. And interestingly, both were kind of side effects of their own success, which, is a good problem to have.
Okay.
First, just stronger overall business performance led directly to higher employee bonus accruals. People hit their targets.
Makes sense. What was the second reason?
The second was the massive run-up in their own stock price. That triggered the vesting of a big chunk of the 2019 CEO Market-Based Award.
Okay, why should the listener care about the payroll tax related to a CEO award vesting? What does that tell us?
It's actually pretty important because it reflects a huge win for the company and its shareholders. That vesting mechanism meant the stock price had to significantly exceed a pretty massive internal target.
Oh, okay.
So hitting that target forced the company to pay an unplanned but significant payroll tax expense, which got reflected in the Q3 costs. It basically confirms that, according to their own long-term incentive plan, management has successfully generated substantial shareholder value.
Got it. So their own success literally drove their expenses higher. Looking ahead to 2026 then, how are they planning to balance this relentless velocity with the need for profitable growth and margin expansion?
They're committing publicly to margin expansion. The plan seems to be asking the existing, more mature business segments to find efficiencies, grow their cost base only in the low single digits.
Okay, tighten belt on the core business.
Right, and then reinvest those savings aggressively into the new growth areas. They specifically mention reinvesting in prediction markets, Robinhood Ventures, and of course, marketing to fuel continued expansion.
Okay, this brings us squarely to what seems like the biggest regulatory elephant in the room right now. Prediction markets, or vent contracts, as they sometimes call them. They're committing capital here, but this product category is attracting a real minefield of legal challenges, isn't it?
It is absolutely the most critical area of regulatory risk they face, bar none. These event contracts, or prediction markets, are facing severe legal hurdles right now. The source material, the earnings call transcript itself, details lawsuits filed in no fewer than 6 states.
6 states, including major ones.
Yeah, including key jurisdictions like Georgia and Illinois.
And what exactly are these lawsuits alleging? What's the basis?
They're alleging violations of a very old law, the Statute of Anne. It goes back centuries.
Statute of Anne. What's that?
It essentially, historically, allowed people to recover gambling losses, and state attorneys are resurrecting this ancient statute to challenge the very legal basis of prediction markets. They're arguing these markets constitute illegal gambling, rather than, say, legitimate financial hedging or information markets.
Wow. Using a centuries-old gambling law.
Yeah, the gravity of having potentially 6 multi-state lawsuits all leaning on this ancient legal precedent, it really can't be overstated. This is a serious threat.
And they've also faced more direct recent regulatory actions too, right, from the CFTC and state regulators.
Yes, absolutely. They've already had run-ins. The CFTC previously requested they suspend certain contracts related to sports events, and the New Jersey Division of Gaming Enforcement actually demanded a cease and desist order for sports contracts offered there.
So the pressure is coming from multiple angles.
Definitely. The core ongoing risk is simply that courts or regulators could ultimately just shut them down, prevent the company from offering event contracts entirely, or maybe just in certain lucrative categories like politics or sports. That would severely curb their ability to capitalize on what they clearly see as a high-growth area.
Okay, a huge regulatory cloud there. Finally, before we wrap up, there was an interesting little peek into their internal philosophy regarding their corporate treasury specifically, the debate about whether they should hold Bitcoin on their own balance sheet.
Yeah, that was an interesting exchange during the Q&A. Management got asked directly about potentially adopting Bitcoin or other digital assets onto the corporate balance sheet, similar to what some other high-profile tech companies have done.
And what was their thinking?
The internal debate, as they laid it out, boils down to alignment versus capital consumption. The pro argument is pretty clear. Holding Bitcoin would align them further with the crypto community, show they have skin in the game.
Makes sense. What are the cons?
The cons include potentially higher regulatory capital requirements if they hold volatile assets directly. And also, there's the pragmatic point that, well, their shareholders can just buy Bitcoin directly on their platform anyway if they want exposure.
So where did they land on that debate?
Their final word was essentially, we're still thinking about it.
Still thinking about it. Okay.
So it shows that while they're absolutely leading the charge on crypto adoption for their customers, they remain very pragmatic, almost conservative perhaps, about incorporating those same highly volatile assets into their own corporate treasury. It suggests a very calculated approach to managing their own risk.
All right. So this deep dive, it really paints a compelling picture, doesn't it? We have this financial titan successfully pulling off a really difficult transition. Q3 was undeniably explosive, driven by those dual engines, high-volume crypto and traditional trading, plus that robust interest income from growing assets under management.
Yeah, the execution on the current business model is impressive.
But the next stage of growth, this whole global financial ecosystem vision, it seems entirely reliant on these incredibly aggressive, high-velocity moves into things like tokenization and maybe even more profoundly, cracking open the private markets for everyday, non-accredited investors.
And that regulatory and legal risk we talked about, that's really the central tension in this whole story, isn't it? They're trying to launch institutional-grade trading tools, bust open the private markets, expand globally through tokenization, and push the legal boundaries of what's considered a contract with prediction markets, all at the same time.
It's like they're fighting on four massive, potentially unprecedented regulatory fronts simultaneously.
Exactly. Each one of those initiatives carries significant regulatory hurdles and potential legal battles.
Which really leaves us with the ultimate question for you, the listener, to consider. This platform has clearly engineered a brilliant pivot. They've generated incredible momentum. The numbers prove that. But can this relentless product velocity actually outrun the inevitable and likely increasing regulatory complexity that these brand new asset classes and market structures attract?
Right. Or will the multi-state lawsuits, the SEC reviews, the international regulatory differences eventually force them to slow down that ambitious trajectory, that friction, that tension between velocity and regulation? That feels like what will define their success or maybe their struggles over the next couple of years.